Dranad Trust here. In this video, I'm going to break down various methods that you can utilize to build wealth. However, it's not going to be fluff and stuff, right? It's going to be numerical examples that you can actually look into and say, okay, this is how this works. All right. So to build wealth, the first area we're going to explore is bonds, right? Now, you're going to want to consider the process when it comes to buying a bond, earning, coupon payments and potential capital gains from price appreciation, right? Now, let's look at this example. You buy a corporate bond with a face value of $1,000, which is please take a moment to hit the subscribe button and the like button. Please take a moment to hit the subscribe button and the like button. And basically a 5% annual coupon rate, meaning $50 per year in interest, right? And a maturity of 2 years. So suppose the bond pays interest semi-annually, so you receive 25 every 6 months. Now let's say the yield to maturity in the market at purchase is 3% annual, compounded semi-annually. To find the bond's value today, discount all future cash flows, whether it's the coupons plus principal at maturity at this YTM. Now, Peter, please put the full list calculation on the screen and put it for at least 15 seconds so the viewers can really break down and really see things vividly, right? So this means you pay $1,038 roughly for a bond with a face value of $1,000 because the coupon rate, which is 5%, is above the market YTM, which is 3%, reflecting a premium price. Now, the wealth building components when it comes to this method, the bond method, is the coupon interest income. So you receive $50 annually or $25 semi-annually, providing steady cash flow. Then there's the capital appreciation. If market interest rates fall after you buy, the bond price usually rises, allowing you to sell above purchase price before maturity. Next, we have the return to maturity. So if held to maturity, you receive $1,000 principal back plus all coupon payments. After that is the diversification and risk management. So bonds reduce portfolio volatility compared to stocks and can hedge against economic downturns. So you can enhance returns by strategies like active trading or swapping bonds to buy undervalued bonds and sell overvalued ones. You have yield curve positioning, which holding bonds that benefit as they roll down the yield the curve. Credit analysis to select bonds with improving issuer fundamentals for building appreciation, right? Potential. Now, you can also look into life insurance, building wealth through life insurance. So that's the next one, right? So let's get into an example here. So let's say you have an annual premium of $1,200, a policy duration of about 30 years, which is, you can say, age 35 to 65. A cash value growth, the premiums are allocated partly to the death benefit, right? The insurer cost. So basically, and the remainder to a cash value account that grows tax deferred. The cash value grows at a guaranteed rate plus potential dividends, right? Which can be reinvested to increase cash value further. Now, the cash value at year 10 would be around, $11,500, accumulated portion of premiums plus interest or the dividends, right? And then the cash value at year 30 would be around $72,000, right? The death benefit at year 30 would be approximately $145,000. Now, how this builds the wealth is over 30 years, your cash value grows tax deferred and can grow, basically can be borrowed, right? Against tax, tax-free. So this access to liquidity basically allows for funding of major expenses, whether it's education, home purchases and emergencies, investing in other appreciating assets without liquidating investments, dividends, which often basically they're paid yearly, that can be used to buy additional paid up insurance, compounding the cash value growth and the death benefit. At death, the death benefit passes to heirs tax-free, creating generational wealth. Right now, let's look at basically when it comes to the returns and loans, let's look at a numeric example, right? By year 10, if you've paid 12,000 total premiums, right? That's basically 1,200 times 10. Your cash value may reach 11,500. By year 16, cash value can exceed premiums paid due to dividends and interest, whether that's 37,000 on a basically 25,000 paid. You can take a loan against your cash value tax-free. For instance, borrowing $20,000 to invest elsewhere or use in retirement, paying interest back on your schedule. Now, here are some important points to look into when it comes to this. Growth is guaranteed but slow initially. So it's basically accelerating as dividends and cash value build. Cash values and death benefits increase over time, enhancing net worth. Loans do not trigger taxes, but unpaid loans reduce the death benefit. Whole life insurance is a conservative, stable asset compared to market investments. Now, that is that avenue. Another avenue to explore is building wealth through rental properties, right? So let's get into an example here. Let's say, for example, a property purchase of $250,000 with a down payment of $20,000, which would be $50,000, right? The loan amount would be $200,000. The interest rate would be 7.5%. The loan term is 30 years. The monthly mortgage is approximately $1,400. Now, the rental income and expenses, the rent per unit is $1,650. The number of units is 2, right? Which brings the total monthly rental income of $3,300. Now, the annual return income would be $3,300 times 12, right? Which would be, $39,600. The operating expenses per year may include the property taxes, which is about 1.5% of purchase price, about $3,750. The insurance, which is $1,000. The vacancy loss, which is 5% of rent, $1,980, which is 5% of $39,600. Now, the capital expenditures, that's the maintenance, repairs, etc. That's about $4,500, 4,500 bucks. Now, the property management fees, if they are applicable, would be $4,500, right? Calculating the net operating income, the NOI, that's the gross rental income, minus the operating expenses, NOI equals the gross rental, and then you have the income minus the operating expenses, assuming the total, operating expenses is $3,750 plus $1,000 plus $1,980 plus $4,560 plus $4,560, which equals around, $15,850. The NOI equals $39,600 minus $15,850, which is about $23,750. Now, the cash flow calculation, right? The cash flow is NOI minus the mortgage payments. So the annual mortgage payments is $1,400 times 12, which is $16,800. The cash flow is the NOI minus the mortgage, payments, which is, $23,750 minus $16,800, which is $6,950 annually, which is about $579 bucks a month. Now, Peter, please put the return metric calculations on the screen. Now, when it comes to the mechanics of wealth building through this avenue, tenants essentially pay down the mortgage principal over time. That's the equity buildup. The property appreciates, typically an example about 3% annual appreciation. After 10 years, the property value might grow to about $350,000, right? You benefit from the tax deductions such as the mortgage interest, depreciation, and operating costs. Now, after the mortgage is paid off, which is around 30 years, rental income becomes nearly pure profit, dramatically increasing the cash flow. Now, there's time to recoup the cash investment. Using annual cash flow of approximately $6,950, time to recover the initial cash outflow of $57,500. So by dividing 57,500 by 6,950 to get roughly 8.3 years. Now, that's that avenue. You can also get into stocks, right? And you want to determine investment capital and allocation. So suppose your annual income is $100,000, living expenses is $60,000, and your emergency fund is $10,000. Your initial investment capital is $100,000 minus $60,000 minus $10,000, right? Which is $30,000, right? Or so if you have a moderately aggressive risk tolerance, you might allocate 75% to stocks and 25% to bonds or treasuries, right? You have to choose a return rate and investment horizon. So assume you invest your $30,000 in stocks, expecting an average annual return of 9%, right? The historical S&P 500 return over 30 years. Now, using the compound interest formula, Peter, please put that on the screen. so that they see what P, R, and T equals on, on the screen. Your initial investment could grow to about 398,100 after 30 years. You have to add regular contributions for wealth building, so adding monthly contributions significantly boosts the growth. Now, as an example, investing in an additional $200 monthly for 30 years at 9% return, you can use the future value of an annuity formula. And Peter, please put that on the screen for them so that they can see what PMT, R, T, and FV equals on the screen. So basically, to total the wealth could be approximately 725,220 after 30 years. Now, the technical and fundamental metrics to monitor is the price earnings ratio. They also call that the PE ratio, which helps you gauge if a stock is over or undervalued by dividing the market price by earnings per share, the EPS, right? The earnings per share indicates profitability per share, which is important for stock selection. You have to look at the risk tolerance and portfolio allocation, so adjust stock/bond proportions per your risk profile to manage volatility and returns. Now, the key things to take away here is to invest consistently, right? Monthly contributions to leverage compounding. You have to use risk-appropriate allocation for balance between growth and safety. So analyze stocks using ratios like the PE and the EPS for informed selection. So that's what I have for you today. Please take a moment right now to hit that subscribe button and the like button. If you want more videos like this and you appreciate this video, please take a moment right now to hit that subscribe button and the like button. I appreciate your viewership. Stay safe and see you on the next video.